The content presented in this video series, including all strategies, examples, and analysis, is strictly for educational and entertainment purposes only. Nothing in this video or the accompanying series constitutes professional financial, investment, or trading advice. Foreign exchange Forex. Trading involves a significant risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The high degree of leverage available in Forex can work against you as well as for you. Before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. We are not licensed financial advisors. You should seek advice from an independent financial advisor if you have any doubts. You are fully responsible for your own trading decisions. 90% of retail traders lose 90% of their capital within their first 90 days of trading. This is known in the industry as the 90-90-90 rule, and it is not an accident. It is a statistical inevitability for those who enter the markets blind. The foreign exchange market is the largest, most liquid financial market in the world, moving over $6 trillion every single day. That is more volume in a single day than the New York Stock Exchange handles in a month. In this ocean of capital, you are swimming alongside central banks, hedge funds, institutional algorithms, and high-frequency trading bots that execute thousands of orders per second. These entities do not trade based on gut feelings. They do not trade based on hope. They trade based on data, probability, and structure. If you enter this arena thinking it is a game of luck, you are not a trader. You are liquidity. You are simply the person paying for the professional's lunch. But there is a way to survive. There is a way to stop being the prey and start reading the footprints of the predators. Welcome to the Deep Dive Masterclass on Technical Analysis in Forex Trading. Over the next 10 comprehensive segments, we are going to completely deconstruct the machinery of the market. We are not here to sell you a magic indicator that turns red to green. We are not here to promise you a Lamborghini by next Tuesday. We are here to solve the single biggest problem facing aspiring traders in the United States and globally today: the inability to distinguish between market noise and actionable signal. Most people look at a price chart and see chaos, jagged lines moving up and down without rhyme or reason. By the end of this masterclass, you will look at that same chart and see a narrative. You will see the psychological footprint of fear and greed playing out in real time. You will understand that technical analysis is not just about drawing support and resistance lines. It is the art of risk management and the science of probability. Shutterstock. To understand why we need technical analysis, we must first understand the environment we are operating in. The Forex market is a decentralized global network where all the world's currencies are exchanged. Unlike the stock market, where you are buying a share of a company, in Forex, you are buying the economic performance of one nation against another. It is a macroeconomic battleground. However, trying to trade solely on news events, what we call fundamental analysis, can be disastrous for the retail trader. By the time you hear the news that the U.S. Federal Reserve has raised interest rates, the institutions have likely already priced that information into the chart hours, or even days ago. The market discounts everything. This is the first major tenet of the philosophy we will be exploring. The price you see on your screen right now is the sum total of every piece of information, every fear, every hope, and every expectation of every participant in the market. This is why we turn to technical analysis. It is the study of market action, primarily through the use of charts, for the purpose of forecasting future price trends. It is built on the premise that history repeats itself. Why does history repeat itself? Because human psychology does not change. The same emotions that drove the Dutch tulip bulb mania in the 17th century are the same emotions driving the euro to US dollar pair today. Fear, greed, hope, and despair create patterns. These patterns are quantifiable. They are recognizable. And most importantly, they are actionable. When we identify a head and shoulders pattern or a double bottom, we aren't just looking at geometry. We are looking at a visual representation of a shift in market sentiment. We are seeing the exact moment where the buyers exhausted their resources and the sellers took control. In this series, we are going to strip away the jargon and build your knowledge from the ground up. We will start with the absolute basics of price action, how to read a candlestick not just as a bar of color, but as a story of a battle between buyers and sellers during a specific time frame. We will move into market structure, learning to identify trends so you never find yourself swimming upstream against the flow of institutional money. We will dissect the critical concepts of support and resistance, not as thin lines on a screen, but as zones of supply and demand where orders are stacked and waiting to trigger. We will explore indicators not as crutches, but as confirmation tools to back up your hypothesis. And finally, we will synthesize all of this into a cohesive trading plan that prioritizes risk management above all else. Let's address the why a bit deeper before we begin. Why does technical analysis work? Critics, often from the academic world, cite the efficient market hypothesis, suggesting that price moves are random and therefore unpredictable. If the market were truly random, there would be no consistent winners. Yet, year after year, we see professional traders and algorithmic systems extract value from the market. This is because the market is not random. It is chaotic but patterned. It is driven by human beings making decisions under stress. Technical analysis is simply a framework for organizing that chaos. It allows you to define your edge. An edge in trading is simply a higher probability of one thing happening over another. It is not a crystal ball. Many beginners misunderstand the purpose of this analysis. They believe the goal is to be right every time. This is a fallacy that leads to ruin. The goal of a professional technical analyst is not to predict the future with 100% accuracy. The goal is to identify scenarios where the potential reward outweighs the potential risk. If you have a setup that works 50% of the time, but your winners are twice as large as your losers, you are a profitable trader. Technical analysis gives you the tools to measure that risk and define that reward. It tells you exactly where you are wrong before you enter the trade. It provides a logical point of invalidation. Without technical analysis, where do you exit a losing trade? When the pain becomes too much. That is an emotional exit, and emotional exits destroy portfolios. With technical analysis, you exit because the market structure has changed, and your thesis is no longer valid. We will also be focusing heavily on the concept of confluence. One signal alone is rarely enough to justify risking your capital. A support level is just a potential floor. But a support level that lines up with the Fibonacci retracement level, a moving average and a bullish candlestick pattern, that is confluence. That is a high probability setup. This series is designed to teach you how to layer these evidences like a detective building a case. We are going to train your reticular activating system, the part of your brain that filters information, to spot these setups instinctively. Furthermore, we must debunk the myth that technical analysis is complex math. It is not. While there are complex indicators based on calculus, the most powerful technical analysis is often the simplest. It is visual. It is about observation. It is about seeing that every time price hit 1.0500 on the euro, it bounced. If it bounced 5 times, is it guaranteed to bounce the 6th time? Absolutely not. But is there a high probability that other traders are watching that same level and have buy orders waiting? Yes. That is the self-fulfilling prophecy of technical analysis. Because millions of traders and algorithms are watching the same key levels, the market reacts at those levels. By learning these concepts, you are learning the language that the market speaks. We are embarking on a journey that requires patience. You cannot watch one video and expect to master this profession. It is akin to learning a new language or a musical instrument. Part 1. Here is your orientation. We are setting the stage. We are calibrating your expectations. You are not going to learn how to exploit the market today. You are going to learn how to respect it. The market can remain irrational longer than you can remain solvent if you do not respect the charts. So, clear your mind of any preconceived notions you have about easy money. Erase the idea that you can outsmart the market. Prepare yourself to become a student of price behavior. In the next 9 parts of this masterclass, we will go from the molecular structure of a single candle to the complex architecture of multi-time frame analysis. We will transform you from a gambler betting on red or black into a risk manager operating a business. The charts are ready to speak. Are you ready to listen? Let's begin. To understand the language of the market, we must first learn its alphabet. In the world of technical analysis, that alphabet is the Japanese candlestick. Before we look at complex charts, we need to travel back in time to 18th century Japan. Imagine the port city of Sakata. This is where Munehisa Homa, a legendary rice merchant, began trading. He realized something profound that changed financial history forever. While there was a link between the supply and demand of rice, the markets were strongly influenced by the emotions of the traders. He didn't just track the price, he tracked the psychology of the buyers and sellers. The system he developed evolved into the candlestick charts you see on every professional trading desk in Wall Street, London, and Tokyo today. Why do we use candlesticks instead of a simple line chart? A line chart connects the closing prices, giving you a smooth curve. It is elegant, but it is incomplete. Tells you who won the war, but it tells you nothing about the battle. A candlestick, however, gives you 4 critical pieces of data for a specific period: the open, the high, the low, and the close. We call this OHLC data. This data creates a visual structure that tells a story of violence, struggle, victory, and defeat within that time frame. Let's dissect the anatomy of a single candle. You have the thick part called the real body, and the thin line sticking out of the top and bottom, known as the wicks or shadows. This structure is not random. The real body represents the distance between the open price and the close price. If the close is higher than the open, the body is typically colored green or white. This indicates bullish pressure. Buyers were in control. If the close is lower than the open, the body is red or black, indicating bearish pressure. Sellers were dominant. Shutterstock. But the real secret, the detail that amateur traders miss, lies in the wicks. The wicks represent the extremes. The highest point of the upper wick tells you the maximum price buyers were able to push the market to before they were beaten back. The lowest point of the lower wick tells you the minimum price sellers forced the market down to before buyers stepped in to defend the price. Imagine a scenario to illustrate this. Let's look at a single 1-hour candle on the pound sterling to US dollar pair. The hour begins and the price opens at 1.3000. Immediately, bad economic news hits the wire. Panic sets in. Sellers flood the market, driving the price down aggressively to 1.2950. On a chart, this would look like a rapidly expanding red bar. At this moment, the bears look unstoppable. But then, institutional orders resting at 1.2950 get triggered. These are the smart money buyers who see value where others see fear. They start buying massive quantities. The sheer volume of buy orders absorbs the selling pressure. The price stops falling and starts to climb. By the end of the hour, the buyers have not only recovered all the losses, but they have pushed the price all the way back up to 1.3010, where the candle closes. What does this look like on the chart? You would see a small green body at the top and a very long lower wick. This specific shape tells a powerful story. It says that although sellers tried to crash the price, they failed. The long lower wick is a visual representation of rejection. It is the footprint of demand entering the market. When you see a long lower wick at a key support level, it is a historical hint that lower prices were rejected by the market participants. Shutterstock. Conversely, imagine the opposite. Price opens, rallies hard, and everyone gets excited. This is it. The retail traders think, we are going to the moon. They buy at the top. But then, the professionals step in and sell into that strength. The price collapses and closes near the bottom. This leaves a long upper wick. That wick is a monument to trapped buyers. It represents a zone where supply overwhelmed demand. This is why the close is the most important price. The open is just the starting gun. The high and low are the boundaries of the conflict, but the close is the settlement. It tells us who held the ground when the bell rang. Now, consider the size of the body. This indicates the strength of the conviction. A Maribozu candle is a candle with a large body and little to no wicks. If it is a large green Maribozu, it means buyers opened the market, drove the price up the entire time, and closed at the very high. There was no hesitation, no pullback, just pure aggression. This suggests strong momentum. On the other hand, a small body with small wicks indicates a lack of interest or volatility. Then we have the doji. This is a candle where the open and close prices are virtually the same. Visually, it looks like a cross or a plus sign. This represents total indecision. It is a stalemate. The buyers pushed up, the sellers pushed down, but in the end, the market ended exactly where it started. Why is this important? Because indecision often precedes a reversal. If a market has been sprinting upwards for days and suddenly prints a doji, it suggests the buyers are tired. The momentum is fading. It is like a runner pausing for breath. The next move could be a collapse. It is crucial to understand that these candlesticks are fractal. This means a single daily candle is actually composed of 24 one-hour candles. If you drill down, that daily candle that looks like a strong green bar might actually hide a rigorous battle that happened during the London session. Professional traders often use multi-time frame analysis to see these layers. They might look at the daily chart to see the overall direction, the war strategy, and then zoom into the 15-minute chart, the tactical battlefield, to find the perfect entry point based on specific candlestick formations. However, a warning is necessary. A candlestick in isolation means nothing. A long wick rejection candle floating in the middle of nowhere on the chart is just noise. Context is king. A bullish rejection candle is only significant if it appears at a level where we historically expect buyers to be, such as a support zone or a trend line. This brings us back to the concept of probability. We are not looking for certainties, we are looking for clues. When a specific candlestick shape aligns with a key price level, the probability of a reaction increases significantly. We must also address the psychological zones these candles create. When a candle closes, it locks in the profit or loss for that time frame. If a large red candle closes, every trader who bought during that time frame is now losing money. Their psychology shifts to fear. They may be looking to sell just to get out at break-even. This creates future resistance. The charts are literally a map of where traders are trapped and where they are profitable. By reading the candles, you are reading the pain thresholds of other market participants. You are beginning to see the matrix. You are no longer seeing random movements. You are seeing rejection, conviction, indecision, and momentum. You are seeing the footprints of the whales. But knowing how to read a single word, a single candle, is not enough to write a novel. You need to understand how these words form sentences, and how those sentences form paragraphs. A single candle tells you what happened in one specific period. But how do we know if the market is actually going up or down over the long term? How do we distinguish a temporary pullback from a full-blown market crash? This requires zooming out and connecting the peaks and valleys. It requires understanding the flow of the river, not just the ripples on the surface. In the next part of this masterclass, we are going to graduate from the micro to the macro. We are going to define the single most important concept in technical analysis: market structure and trend identification. We will explain why the trend is your friend is more than a cliché. It is a survival mechanism. We will show you how to draw trend lines that professional algorithms respect, and how to spot a trend reversal before the news even talks about it. You have learned the alphabet. Now it is time to learn the grammar of the market. Stay locked in. If candlesticks are the alphabet, then market structure is the grammar. It is the set of rules that governs how price moves from point A to point B. Without understanding market structure, you are reading words in a random order. You might recognize the individual pieces, a bullish engulfing candle here, a doji there, but you will miss the entire sentence. You will be buying when the market is screaming sell, simply because you focused on a single tree and missed the forest. Understanding market structure is the difference between being a blind gambler and a strategic navigator. It provides the context that validates or invalidates every single trade setup you will ever take. Let's shatter a common illusion immediately. Price does not move in a straight line. It never has, and it never will. If you look at a chart of the S&P 500 or the US dollar to Japanese yen over the last decade, it looks like a jagged lightning bolt. It moves in waves. These waves are composed of two distinct phases: the impulse phase and the corrective phase. The impulse is the strong, aggressive move in the direction of the trend. It is where the momentum lives. The correction is the pause, the pullback, the moment where traders take profits and the market catches its breath. Mastering market structure is simply the ability to identify which phase you are in and, more importantly, the overall direction of these waves. Broadly speaking, the market can only exist in three states: an uptrend, a downtrend, or a consolidation. Identifying which state the market is currently in is the first step of any professional analysis. Let's deeply analyze the uptrend. An uptrend is not just price going up. That is too vague for a technician. An uptrend is technically defined by a specific sequence, a series of higher highs and higher lows. Imagine you are walking up a staircase. You step up to a landing, that is your higher high. You pause to catch your breath, maybe stepping back slightly, that is your higher low. As long as you do not fall below the previous landing, you are making progress upwards. In a Forex context, let's say the euro to US dollar moves from 1.0500 to 1.0600. That peak at 1.0600 is a high. The price then pulls back to 1.0550. This is the critical moment. If buyers step in at 1.0550 and push the price up past 1.0600 to 1.0650, we have confirmed a structure. The low at 1.0550 is higher than the starting point of 1.0500. It is a higher low. The new peak at 1.0650 is higher than the old peak. It is a higher high. This confirms the trend is bullish. Why does this happen? It is a reflection of aggressive demand. Buyers are willing to purchase at higher and higher prices, higher highs, and crucially, They are unwilling to let the price fall back to previous cheap levels, higher lows. They support the price earlier each time it drops. When you are in an uptrend, the strategy is simple but difficult to execute psychologically. You buy the dips. You do not try to short the peaks. Trying to sell the top of an uptrend is like standing in front of a freight train hoping it stops exactly where you are standing. It is a high probability way to lose capital. Conversely, we have the downtrend. This is the mirror image. It is defined by a series of lower lows and lower highs. Using the staircase analogy, you are walking down into a basement. You step down, pause, and step down again. In a downtrend, the sentiment is dominated by supply. Sellers are aggressive, pushing price to new depths, lower lows. When the price tries to rally, it runs out of steam at a level lower than the previous peak, lower high. This indicates that buyers are weak and sellers are eager to unload their positions at worse and worse prices just to get out. In this environment, you look to sell the rallies. Then, there is the third state, consolidation or the ranging market. This is where the stairs disappear, and the price bounces between a specific floor and a specific ceiling. We see equal highs and equal lows. This is the meat grinder for retail traders. Statistics suggest that markets trend only about 30% of the time. The other 70% they are chopping sideways. In a range, the battle between buyers and sellers is balanced. No one is winning. The institutions are often accumulating positions here, building up energy for the next major move. If you try to apply trend-following strategies in a ranging market, buying a breakout that immediately fails, you will suffer what is known as death by 1,000 cuts. Identifying a range saves you money by telling you when not to trade, or to switch to a range-bound strategy like buying the bottom and selling the top. Now let's introduce the tool that makes these structures visible: the trend line. Drawing a trend line is an art form that many get wrong. A trend line is not just a line connecting two random points. It is a dynamic level of support or resistance. To draw a valid bullish trend line, you need to connect at least two higher lows. However, a trend line is not confirmed until the price touches it a third time and bounces. There is a nuance here that separates the pros from the rookies. Do not treat trend lines as rigid, pixel-perfect glass walls. Treat them as zones or rubber bands. Often, price will spike through a trend line briefly to grab liquidity, triggering stop losses, before moving back in the original direction. If you redraw your line every time a wick pokes through, your chart will look like a spiderweb of nonsense. Focus on the touches. The more times price touches a trend line and respects it, the stronger that trend line is. But be warned, a trend line that is touched too many times can eventually break. It is like a frozen lake. The more you jump on the ice, the more likely it is to crack. Let's apply this to a what-if scenario on the pound sterling to Japanese yen pair, often called the beast due to its volatility. Imagine the pair has been in a strong uptrend for weeks, printing higher highs and higher lows. You draw a trend line connecting the lows. The price comes back to your trend line. This is a potential buy zone. However, relying solely on the line is risky. You wait. You look for one of the candlestick patterns we discussed in part 2, perhaps a bullish hammer forming exactly on the trend line. Now you have structure uptrend, plus entry signal, candlestick, plus location, trend line. This is confluence. This is how you stack the odds. But nothing lasts forever. Trends eventually end. How do we spot the reversal before the mass media reports it? We look for a break of structure, BOS, or a change of character. Imagine our uptrending staircase again. We make a higher high then a higher low. We expect the next move to break the high. But instead the price fails to make a new high. Stalls. Then it turns around and smashes down below the previous higher low. This is the critical moment. The sequence is broken. We no longer have higher lows, we have a lower low. This is the first major structural warning that the uptrend is dead. The psychology has shifted from buy the dip to sell the rally. Many inexperienced traders try to catch the exact top. They see the price go up and say, "It can't go any higher." They sell and the market runs them over. Professional traders wait for the structure to break. They sacrifice the first 10% of the move to ensure they are on the right side of the new trend. They wait for the market to prove it has changed its mind. They let the lower low print, then they wait for a retracement to set a lower high, and that is where they strike. Understanding market structure also solves the problem of time frames. New traders often ask, is the trend up or down? The answer depends on your perspective. The euro to US dollar can be in a massive downtrend on the monthly chart, but in a strong uptrend on the 1-hour chart. This is called fractal nature. A 1-hour uptrend might just be a small corrective pullback within a larger daily downtrend. So how do you trade this? You align yourself. If the daily chart is in a downtrend, and the 1-hour chart shifts into a downtrend, you have the wind at your back on both the macro and micro levels. These are the trades that slide effortlessly into profit. You are swimming with the current of the river, not against it. You now understand the alphabet, candlesticks, and the grammar market structure. You can read the sentence. You can see the direction the market is moving. But a map is useless if you don't know where the safe houses are. You can identify an uptrend, but if you buy at the wrong spot, the market can still stop you out before continuing up. You need to know exactly where the price is likely to stop, turn, and react. You need to identify the invisible barriers that hold the market together. In the next part, we are going to reveal the backbone of technical trading: support and resistance. But we aren't just going to draw horizontal lines. We are going to explore supply and demand zones, the specific footprints where institutions have left their pending orders. We will show you why resistance becomes support, and how to spot a fake out before it drains your account. The map is unfolding. Part 4 is where we mark the X. Welcome to the architecture of the market. If you were to strip away every indicator, every moving average, and every complex algorithm, and look at a naked chart, the only thing that would remain relevant is support and resistance. This is the bedrock of technical analysis. However, the way most beginners are taught to draw these levels is fundamentally flawed and leads to unnecessary losses. They draw thin, precise lines at a specific price point, like 1.0500, and expect the market to bounce off it like a rubber ball hitting a concrete wall. The market is not concrete. It is fluid. It is water. Sloshes. It overshoots. This is why we must shift your paradigm from thinking in lines to thinking in zones. A support zone is not a single price. It is a price range where buying interest is sufficiently strong to overcome selling pressure. Think of it as a floor, but a floor made of a trampoline. When price hits it, it might depress the surface slightly before springing back up. If you place your stop loss exactly at the line, the trampoline effect will take you out of the trade just before the market goes in your favor. Let's analyze the psychology behind these zones. Why does the market respect a level like 150.00 on the US dollar to Japanese yen pair? Because the market has a memory. Imagine a massive hedge fund decided that 150.00 was too expensive 2 weeks ago and sold heavily, driving the price down. Now, the price is approaching 150.00 again. The traders who missed the sell opportunity the first time are waiting. The traders who sold and made money are looking to defend their position. The traders who bought at the top and have been holding a losing position for weeks are praying for the price to get back to break-even, so they can exit without a loss. All these psychological forces converge at this single zone, creating a massive wall of sell orders. This is resistance, a ceiling where supply exceeds demand. Conversely, support is where demand exceeds supply. It is a price level that the market perceives as cheap or undervalued. When the price falls into a support zone, the sellers start to take profits, which means they are buying back their positions, and fresh buyers enter the market looking for a bargain. This dual pressure halts the decline and reverses the price. One of the most high probability phenomena in trading is the concept of role reversal, or polarity. This occurs when a resistance level breaks and becomes support, or vice versa. This is not magic, it is logic. Imagine a ceiling that has held the price down for months. Suddenly, a burst of buying volume punches through that ceiling. The price is now trading above it. Now, think about the traders who sold at that resistance expecting it to hold. They are now trapped in losing positions. As the price eventually dips back down to that old ceiling, those trapped sellers are desperate to close their trades at break-even to avoid a loss. To close a sell position, they must buy. Simultaneously, traders who missed the breakout are waiting for a retest to enter long. They also buy. This combination of trapped shorts covering and fresh longs entering turns the old ceiling into a new solid floor. Understanding this transition is how you stop chasing price and start letting the price come to you. Now let's upgrade your toolkit. While support and resistance are classical concepts, professional institutional traders often operate using supply and demand zones. These are more specific and tell a deeper story about order flow. Shutterstock. Explore. A supply zone is formed when there is an explosive move downwards from a consolidation. Imagine the market is moving sideways, and then suddenly, a massive red candle prints, dropping the price 50 pips in minutes. This implies that an institutional whale entered the market with such volume that they consumed all the buy orders instantly. However, institutions rarely get all their orders filled in one go. They might have wanted to sell 100 million units but only got 50 million filled before the price dropped too low. They leave the remaining 50 million limit orders sitting at the origin of the drop. When price eventually climbs back up to this zone, those pending orders trigger, and the price drops again. Identifying these zones, marked by aggressive departures, gives you a glimpse into the institutional order book. However, the market is a predator and you are the prey. This brings us to the fake out, or the liquidity grab. This is the most common reason retail traders lose money at support and resistance. You see a clear resistance level. You place your sell limit right at the line, and you place your stop loss just above it. You think you are being safe. The market makers know this. They know exactly where the retail stop losses are clustered. It is a pool of liquidity. Often, just before a major drop, the price will spike through the resistance level, triggering all the buy stops liquidity from the breakout traders and hitting the stop losses of the short sellers. This action provides the necessary volume for the institutions to fill their massive sell orders. Once their liquidity needs are met, the price aggressively reverses and dumps, leaving the retail traders stopped out and confused. If you have ever said, "The market hit my stop loss to the pip and then went exactly where I thought it would," you were a victim of a liquidity grab. To combat this, you must wait for confirmation. Do not blindly set limit orders at the edge of a zone. Wait to see how the price reacts. Does it spike through and immediately reject, leaving a long wick? That is a sign of a fake out, and it is often a better entry signal than the touch itself. Here is a step-by-step protocol for drawing these zones on your chart today. Start on a higher time frame like the weekly or daily chart. Look for the obvious turning points, the V-shapes and inverted V-shapes where price change direction sharply. Draw a rectangle that encompasses the candle bodies and the wicks of that turning point. Extend that rectangle to the right. This is your macro zone. Now drop down to the 1 hour or 4 hour chart. You will see how price reacts to these zones with incredible precision. You are building a map of the battlefield before the war begins. Remember, the more times a zone is tested, the weaker it potentially becomes. This is counterintuitive to what many books say. Think of a wooden door. The first time you ram it, it holds strong. The second time, it cracks. The fifth time you hit it, you are likely to smash right through. If a support level has been tested 5 times, the buyers at that level are being exhausted. Their orders are being filled. Eventually, there will be no one left to buy, and the floor will collapse. Be wary of taking trades on the 4th or 5th touch of a level. We have now defined the horizontal landscape of the market. We know where the floors and ceilings are. We know where the banks have left their orders. But the market is not always moving sideways or bouncing between horizontal levels. Sometimes, the market is in a dynamic state of flow, moving diagonally with momentum. What if the support level isn't a fixed price but a moving target? What if the floor rises with the price? This is where dynamic support and resistance come into play. In the next part of this masterclass, we are going to introduce the most widely used, yet most misunderstood, tools in trading: moving averages. We will debunk the idea that they predict the future and show you how to use them as a dynamic shield for your trades. We will explain the golden cross and the death cross, and why smart traders use them differently than the masses. The static map is complete. Now we add the element of motion. Part 5 is next. Imagine a sniper trying to hit a moving target. If the target is standing still, aiming is simple. You calculate the distance, the wind, and you fire. But if the target is sprinting across a field, aiming at where the target is will guarantee a miss. You have to aim at where the target is going to be. In the previous sections, we built a fortress of static defenses, support, and resistance. These horizontal zones are powerful, but they are stationary. The market, however, is a kinetic entity. It has velocity. It has momentum. To track a market in motion, you cannot rely solely on fixed coordinates. You need a tool that evolves with the price action. You need moving averages. A moving average, or MA, is essentially a dynamic trend line that curves and adapts to the changing data. At its core, it is a statistical calculation that smooths out price action by filtering out the noise of random price fluctuations. It looks at the average closing price over a specific number of past periods. For example, a 50-period moving average on a daily chart takes the closing prices of the last 50 days, adds them up, divides by 50, and plots a single point. It does this every single day, connecting the dots to form a smooth line that trails the price. However, not all moving averages are created equal. In the professional trading world, we generally distinguish between two heavyweight contenders: the simple moving average, SMA, and the exponential moving average, EMA. The difference is subtle mathematically, but massive strategically. The simple moving average treats every candle equally. The price from 50 days ago is just as important to the calculation as the price from yesterday. This creates a very smooth, slow-moving line. It is excellent for identifying the long-term macro trend, but it is often too slow for entering trades. It is like steering a cruise ship. It takes a long time to turn. Enter the exponential moving average. The EMA applies a weighting factor to the data, giving significantly more importance to the most recent prices. It reacts faster to recent price changes. If the SMA is a cruise ship, the EMA is a speedboat. For traders looking to catch swings and trends early, the EMA is the preferred weapon. It hugs the price action tighter and provides signals sooner. In this masterclass, we primarily focus on the EMA because in the fast-paced world of Forex, lag is the enemy. Let's discuss the most critical function of these lines: dynamic support and resistance. Just as price bounces off a horizontal floor, it often respects these moving lines as if they were physical barriers. This is due to the self-fulfilling prophecy of institutional algorithms. Large banks and hedge funds often program their trading bots to buy when the price retraces to the mean or the average. Imagine the euro to US dollar is in a strong uptrend. It surges up, then pulls back. It doesn't hit a horizontal support level, but it touches the 50-period EMA perfectly. Suddenly, it bounces and rallies to a new high. Why? Because that EMA represents the fair value of the trend at that moment. When price is far above the EMA, it is considered expensive or overextended. When it touches the EMA, it is considered fair. Traders wait for this return to value to enter the trend at a discount. This is the pullback strategy. You are not chasing the green candles. You are waiting for the price to come back to your dynamic safety net. Now we must address the king of all indicators, the 200-period moving average. This line is watched by virtually every major financial institution on the planet. On a daily chart, the 200 EMA is the dividing line between a bull market and a bear market. The rule of thumb for long-term trend followers is brutally simple. If the price is above the 200 EMA, you only look for buy setups. If the price is below the 200 EMA, you only look for sell setups. Trading against the 200 EMA is often referred to as picking up pennies in front of a steamroller. It works until it doesn't, and when it doesn't, you get crushed. You may have heard the terms golden cross and death cross on financial news channels like CNBC or Bloomberg. These are major signals generated by the interaction of two moving averages, usually the 50-period, short-term, and the 200-period, long-term. A golden cross occurs when the faster 50 EMA crosses above the slower 200 EMA. This signals that short-term momentum is outpacing long-term sentiment, suggesting the birth of a new bull market. Conversely, a death cross happens when the 50 crosses below the 200, signaling a potential long-term crash. However, and this is a massive disclaimer that separates professionals from amateurs, moving averages are lagging indicators. They rely on past data. By the time a golden cross actually prints on the chart, the market may have already rallied for weeks. If you buy blindly the moment the cross happens, you might be buying the exact top before a correction. These crosses should be used as a confirmation of a long-term bias shift, not as an immediate trigger to bet the farm. They tell you the climate, not the weather. There is also a dangerous trap you must avoid: the whipsaw. Moving averages work beautifully in trending markets. In a strong uptrend or downtrend, they act like a perfect guide. But remember our statistic from part 3? Markets range 70% of the time. In a sideways, consolidating market, price will cross above and below the moving average repeatedly and erratically. The line becomes flat. If you try to trade crossovers in a ranging market, you will be bought in at the top and sold out at the bottom over and over again. This is the meat grinder. When you see your moving averages flatten out and intertwine like spaghetti, that is a signal to stand down. Put your hands in your pockets. The trend is dead, and the moving average has lost its predictive power. Another advanced concept is the rubber band effect, technically known as mean reversion. Price has an elastic relationship with the moving average. It can stretch away from the average, but it cannot stay there forever. Eventually, the tension becomes too great and the price snaps back. If you see a candle that is exceptionally far away from the 20 EMA, Beware of entering a trade in the direction of the trend. You are buying at a premium. The probability favors a snapback to the mean. Smart traders often take profits when the price is overextended from the MA and re-enter when it touches the MA. So, how do we construct a strategy with this? Imagine a triple screen approach. You look at the daily chart and see price is above the 200 EMA, trend is up. You look at the 4-hour chart and see price has pulled back and is testing the 50 EMA, dynamic support. You then look at the 1-hour chart and see a bullish hammer candlestick forming. This is a high probability setup. You have the macro trend 200 EMA, the value zone 50 EMA, and the entry signal candlestick all aligned. But even with dynamic support, we are still missing a crucial piece of the puzzle. We know the direction trend, we know the location support, resistance/MA, but we do not know the strength of the move. Is the gas tank full? Or is the car running on fumes? A trend can look healthy on the surface but be rotting from the inside, ready to collapse at any moment. How do we measure the internal horsepower of a price move? How do we know if a market is overbought and ready to fall, or oversold and ready to rally, before the reversal actually happens? This requires a different class of tools entirely. We need to look under the hood of the market. In the next part of this masterclass, we enter the world of oscillators. We will demystify the Relative Strength Index, RSI, and the MACD. We will teach you to spot divergence, one of the most powerful reversal signals in existence, where the indicator tells you the exact opposite of what the price is doing. This is often the leading indicator that spots the turn before the moving averages ever catch up. We are about to add X-ray vision to your trading desk. Part 6 is coming up. You have built the car. You have the chassis of market structure, the engine of price action, and the steering wheel of support and resistance. You even have moving averages acting as your navigation system. But imagine driving a high-performance vehicle at 150 miles per hour without a speedometer or a tachometer. You wouldn't know if you were redlining the engine. You wouldn't know if you were running out of fuel just as you hit the steepest part of the hill. This is exactly what trading without oscillators feels like. Shutterstock. While moving averages are trend-following indicators that smooth out the past, oscillators are momentum indicators designed to measure the velocity and magnitude of price movements. They operate in a separate window below your chart, usually bounded between 0 and 100 or oscillating around a center line. They allow you to look under the hood of the market and see if the buying or selling pressure is sustainable. We are going to master the two most powerful tools in this category: the Relative Strength Index, RSI, and the Moving Average Convergence Divergence, MACD. Let's start with the RSI. Developed by J. Wells Wilder in 1978, this tool is a staple on almost every professional trading desk. The standard setting is 14 periods. It measures the speed and change of price movements. The traditional interpretation is painfully simple, and for most beginners painfully expensive. The textbooks tell you, if RSI is above 70, the market is overbought, so sell. If RSI is below 30, the market is oversold, so buy. If you follow this advice blindly in a strong trend, you will go bankrupt. Imagine the US dollar to Canadian dollar pair is in a ferocious uptrend. Aggressive institutional buying is pushing the price vertical. The RSI hits 70. You sell thinking it's too high, but the price keeps rallying. The RSI hits 80. You double down on your sell. The price rallies further. The RSI hits 85. Your account is blown. Why? Because in a strong trend, the market can remain overbought for days, weeks, or even months. An overbought condition is not a sell signal. It is a sign of strength. Tells you the bulls are in total control. So, how do professionals use the RSI? We use it to identify conditions, not triggers. When RSI breaks above 70, we acknowledge that the market is extended. We stop looking to buy at the market price because the risk-to-reward ratio is poor. We wait for a pullback. Conversely, if the RSI is hovering around 50 and bounces up, it acts as a trend confirmation, showing us there is still plenty of room for the move to expand before exhaustion sets in. Now let's introduce the heavyweight champion of momentum, the MACD. This stands for Moving Average Convergence Divergence. It sounds complex, but the concept is elegant. It tracks the relationship between two moving averages of price, usually the 12-period and 26-period EMAs. When these two averages move apart, diverge, momentum is increasing. When they move together, converge, momentum is slowing down. The MACD histogram, those little bars that grow and shrink above and below the zero line, is arguably the most valuable part of the indicator. It gives you a visual representation of the distance between the two moving averages. When the histogram is growing larger in green, the bulls are pressing the gas pedal. When the histogram starts to shrink or turns a lighter color, even if the price is still going up, it tells you the bulls are taking their foot off the gas. The car is still moving forward due to inertia, but the acceleration is gone. This is your early warning system. This brings us to the absolute holy grail concept of oscillator analysis: divergence. If you take only one thing from this entire masterclass, let it be this: divergence is one of the few instances where an indicator can actually lead the price. It occurs when the price action and the oscillator disagree. Regular divergence is a reversal signal. Imagine a scenario on the pound sterling to US dollar daily chart. The price rallies and hits a high of 1.2500. It pulls back, then rallies again to hit a new high of 1.2600. The price chart shows a higher high. This looks bullish. Everyone is excited. But then you look down at your RSI or MACD. At the first peak, 1.2500, the RSI was at 75. At the second higher peak, 1.2600, the RSI is only at 65. Do you see the discrepancy? The price made a higher high, but the momentum made a lower high. This is bearish divergence. It screams that the second rally was weak. It was a fake move driven by lagging retail orders, not smart money conviction. The engine is redlining, but the car isn't accelerating. This specific setup often precedes a major market collapse. Identifying this allows you to exit your long positions at the absolute peak, while the rest of the crowd is still buying the breakout. Conversely, bullish divergence happens in a downtrend. Price makes a lower low, smashing through support, scaring everyone into selling. But the RSI makes a higher low. This tells you the sellers are exhausted. The elastic band is stretched too far. A violent snapback rally is imminent. But the professionals go one step deeper. They look for hidden divergence. While regular divergence signals a reversal, hidden divergence signals a continuation. It is the secret to entering an existing trend with surgical precision. Imagine an uptrend. Price pulls back to a support level. The price creates a higher low compared to the previous dip, maintaining market structure. However, the RSI drops significantly lower than it did during the previous dip, creating a lower low. This is hidden bullish divergence. It indicates that the oscillator has reset or cooled off completely, even though price has maintained its bullish structure. It implies that the sellers used maximum effort to push the price down, but failed to break the structural low. This is a massive buy signal. It's like pulling back a slingshot. The further you pull it back, oscillator reset. Without breaking the band price structure, the farther the shot will fly. Let's synthesize this into a case study execution. You are watching the Australian dollar to US dollar. Structure. You see higher highs and higher lows on the 4-hour chart. You are biased long. Location. Price pulls back to a key support zone that aligns with the 50 EMA. Momentum, you look at the RSI. It has dropped below 30, oversold during this pullback. This is good. We want to buy when the car has slowed down, not when it's speeding. Trigger. You zoom into the 1-hour chart. You see the price make a slightly lower low into the zone, but the MACD histogram makes a higher low, bullish divergence. This is the moment. You have structure plus support plus dynamic EMA plus oversold condition plus bullish divergence. The probability of this trade working out is exponentially higher than simply buying because it looks low. You are no longer guessing. You are executing a business plan based on data confluence. However, a warning: oscillators are mathematically bound. They cannot float to infinity like price can. In a parabolic market event, like a currency peg breaking or a massive geopolitical crisis, oscillators become useless. They will flatline at 100 or 0 while price moves thousands of pips. In these rare black swan events, you must abandon the oscillator and trust only pure price action. Do not try to fade a parabolic move just because the RSI says, overbought. The market can stay irrational longer than you can stay solvent. We have covered the engine, the map, the road, and the dashboard. You can now tell direction, key levels, and engine health. But there is one question we haven't answered with mathematical precision yet. When the market pulls back, exactly how deep will that pullback be? Will it retrace 50% of the move? 60%? Is there a mathematical code underlying the chaos of human behavior? Turns out there is. It dates back to the 13th century. Discovered by an Italian mathematician named Leonardo of Pisa. You might know him by his nickname. The numbers he discovered are found in the spirals of galaxies, the breeding of rabbits, the petals of flowers, and yes, the algorithms of high-frequency trading bots. In the next part of this masterclass, we are going to unlock the magic numbers of trading. We are going to teach you how to use Fibonacci retracements and extensions. We will show you why the 0.618 level is a self-fulfilling prophecy worth trillions of dollars, and how to use it to snipe the exact bottom of a correction. The code of the universe is about to be applied to your bank account. Part 7 is next. Is there a hidden mathematical order to the chaos of the financial markets? Is it possible that the same ratio governing the spiral of a galaxy, the arrangement of petals on a rose, and the proportions of the human body also dictates exactly where the price of Bitcoin or the euro will stop falling? The answer, supported by decades of market data, is a resounding yes. Welcome to the world of Fibonacci. To the uninitiated, drawing colorful lines across a chart based on 13th century mathematics seems like voodoo. Feels like astrology for men in suits. But in the world of high-frequency trading and institutional capital allocation, Fibonacci ratios are as real as gravity. They act as the invisible architecture of market psychology. Let's briefly ground this in history. Leonardo Pisano Bigallo, known as Fibonacci, introduced a sequence of numbers to the West, 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on. Each number is the sum of the two preceding ones. But the magic isn't in the numbers themselves, it is in the ratio between them. If you divide any number in the sequence by the one that follows it, you get approximately 0.618. If you divide it by the number 2 places ahead, you get 0.382. This 0.618 is known as phi, or the golden ratio. Why does this matter to your bank account? Because human beings are biologically hardwired to recognize this ratio as balanced or complete. Since the market is a reflection of human psychology, price action naturally gravitates toward these ratios during a correction. Furthermore, because millions of traders and thousands of bank algorithms are programmed to watch these specific levels, they become a self-fulfilling prophecy. When the algorithm sees price hit the 61.8% retracement, it triggers a buy order. When enough algorithms do this simultaneously, the market bounces. So, how do we use this tool to catch a falling knife without getting cut? We use the Fibonacci retracement tool to measure the heartbeat of a trend. Imagine the market is in an uptrend. It surges from a low price of $100, swing low, to a high price of $200, swing high. That is the impulse leg. Now the market begins to pull back. Traders are taking profit. The price starts dropping. $190, $180, $170. The amateur trader is panicking, thinking the trend is over. The professional trader is calm. They have drawn their Fibonacci tool from the swing low to the swing high. They are simply waiting for the price to hit a specific discount level before rejoining the trend. The tool projects horizontal lines at specific percentages: 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Think of these as layers of a safety net. The 23.6% level is for extremely strong, aggressive trends. If price only dips this shallow before rocketing up again, it tells you the buyers are frantic. They aren't even waiting for a sale. However, entering here is risky because the stop loss is wide. The 38.2% is the standard pullback. In a healthy, steady trend, price often taps this level and continues. Then we have the 50% level. Technically, 0.50 is not a Fibonacci number, but it is included in every software package because of Dow theory. It is a psychological midpoint. If something costs $100 and goes on sale for $50, people perceive it as fair value. The market often respects this halfway point simply because of crowd consensus. But the true magic happens lower down. The zone between 0.618 and 0.65 is known in the industry as the golden pocket. This is the sniper's hideout. This is where the risk-to-reward ratio is mathematically superior. If the price retraces all the way back to the 61.8% level, it means the asset is on a deep discount. It has erased over 60% of the initial move. This shakes out all the weak hands and late buyers. When the price enters the golden pocket, professional traders start looking for rejection candles. If you enter a trade here, your stop loss can be placed just below the swing low. Because your entry is so deep, your potential upside is massive compared to your risk. You might be risking $100 to make $500. That is a 1 to 5 risk-reward ratio. You can lose 4 trades in a row, win the 5th one, and still be in profit. That is the power of the golden pocket. Let's construct a rigorous imagine-if scenario to lock this in. Imagine you are trading the euro to Japanese yen. The pair has just exploded upwards, breaking through a major resistance ceiling. You missed the breakout. Do not chase it. Chasing is for liquidity. You wait. You identify the bottom of the move, swing low, and the top where it stalled, swing high. You drag your Fibonacci tool from wick to wick. You sit on your hands. The price starts to bleed down. It smashes through the 23.6%. It slices through the 38.2%. It hovers at the 50% for a moment, teasing a reversal, but then drops further. Finally, it touches the 0.618 level at exactly 155.50. Now you look left. You notice that 155.50 also happens to be a previous resistance level that was broken. Recall part 4. Resistance becomes support. You look at your indicators. The RSI is oversold. Part 6. You look at the chart pattern. A bullish pin bar candle forms right on the 61.8 line. You have Fibonacci golden ratio, 61.8%. Structural support, roll reversal. Momentum reset RSI. Price action signal pin bar. This is confluence. This is a 4-star trade setup. You place your buy order. You place your stop loss below the 78.6% or the swing low. But where do you exit? This brings us to the other side of the coin. Fibonacci extensions. Just as the golden ratio predicts where price stops falling, it also predicts where price will stop rising. If the market bounces from the 61.8% level historically, it tends to target the -0.272 and the -0.618 levels above the swing high. These are your algorithmic take-profit zones. So, in our euro to Japanese yen example, you buy at the bottom of the pullback. You ride the wave back up. As the price breaks the old high, the amateurs are just starting to buy again, fueling your profit. You exit your position exactly at the -0.272 extension, right as the price hits a wall and reverses. You bought the fear and sold the greed, guided entirely by a sequence of numbers discovered in 1202 AD. A critical warning, however: Fibonacci is a tool, not a crystal ball. It works best on major swing points. If you draw a Fibonacci retracement on a tiny choppy range during lunchtime trading, you are just drawing nonsense on a screen. It requires a clear, defined impulse move to be valid. Also, the market will not always respect the 61.8. Sometimes it crashes right through to the 100% level. This is why we never place a limit order blindly. We wait for the price to react to the level. We need to see the buyers actually step in before we join them. You now possess the ability to measure the hidden elasticity of the market. You can identify the discount zones where the smart money accumulates positions. But trading isn't just about horizontal levels and mathematical ratios. Sometimes the market paints geometric shapes. Triangles, wedges, flags, pennants. These aren't just random art. They are coils of energy. They represent the compression of price before an explosion. When a market moves sideways, it is building potential energy. The tighter the coil, the more violent the release. In the next part of this masterclass, we are going to teach you chart geometry. We will decode the classic chart patterns. We will show you why a bull flag is the safest continuation trade in existence, and how a head and shoulders pattern can warn you of a crash weeks before it happens. You are going to learn to recognize the shapes of accumulation and distribution. Part 8 is where art meets analytics. To the untrained eye, a price chart is just a random jagged line. But to the professional technician, it is a canvas painted with geometric shapes that reveal the hidden intentions of the market. These shapes, triangles, wedges, flags, and pennants, are not merely lines drawn for aesthetic purposes. They are visual representations of psychological pressure cookers. They show us exactly where buyers and sellers are battling for control, where energy is being accumulated, and most importantly, where that energy is likely to explode. Shutterstock. Explore. We categorize these patterns into 2 distinct families: continuation patterns and reversal patterns. Understanding the difference between the two is the difference between betting on a train to keep moving or betting on it to crash. Let's start with the most reliable moneymaker in trending markets: the bull flag. Imagine a sprinter running a 100-meter dash. They sprint aggressively for 60 meters. This is the impulse leg, or the pole. Then they get tired. They need to slow down, catch their breath, and jog slowly. On a chart, this looks like a sharp vertical rise followed by a tight, downward sloping channel where the price drifts slightly lower or moves sideways. This consolidation phase is critical. It is not a reversal. It is profit-taking. The early buyers are cashing out, and new buyers are stepping in to accumulate positions at a slightly better price. The market is refueling. As a trader, if you miss the initial explosion, the pull, you do not chase the price. You wait for the flag. When the price breaks out of the top of that flag channel, it signals that the sprinter has caught their breath and is ready to finish the race. But here is where the science comes in. We use a concept called the measured move. Historical data suggests that the length of the movement after the breakout is often equal to the length of the movement before the flag. If the pull was a 100 pip rise, you can mathematically project a target of another 100 pips from the breakout point. This gives you a concrete, data-driven take-profit level rather than a guess. Now, contrast this with the head and shoulders pattern. This is the most famous pattern in trading because it is the quintessential killer of trends. It is a reversal pattern. Visualize the psychology of an uptrend. Higher highs and higher lows. The market pushes up to a peak, left shoulder, and pulls back. Then buyers rush in aggressively and push the price to a new higher peak, the head. Everything looks bullish. The price pulls back again. But then something changes. The buyers try to push the price up a third time, but they are exhausted. They cannot make a new high. They stall out at a lower peak, right shoulder, and roll over. This structure tells a tragic story for the bulls. The sequence of higher highs has been broken. The neckline, the support level connecting the two lows, is the final line of defense. When the price crashes through that neckline, the uptrend is officially dead. The smart money has finished distributing their shares to the dumb money at the top, and now they are shorting the market. Just like the flag, we can measure the target. We take the vertical distance from the top of the head to the neckline and project that distance downwards from the breakout point. Let's deepen the complexity with the symmetrical triangle. This is a bilateral pattern, representing a state of total compression and indecision. Imagine a coil spring being squeezed from both ends. You see a series of lower highs, sellers getting desperate to sell at lower prices, and higher lows, buyers getting desperate to buy at higher prices. The price range gets tighter and tighter. The volatility dries up. The volume drops. Shutterstock. Explore. This silence is deceptive. It is the calm before the storm. The market is building potential energy. Unlike a flag or a head and shoulders, a symmetrical triangle does not have a built-in bias. It can break in either direction. This traps many amateur traders who try to guess the direction before the break. The professional strategy here is OCD, obsessive breakout discipline. You do not trade inside the triangle. You wait for the candle to close outside of the perimeter. Only then has the winner of the tug-of-war been declared. However, we must discuss the bull trap and the bear trap. In the age of algorithmic trading, patterns are often used as weapons against retail traders. Algorithms know that millions of traders have read the same textbooks. They know that if a bull flag forms, retail traders will put their buy-stop orders just above the upper line. So what happens? The price spikes up, triggering all those buy orders. The retail traders cheer. Breakout. But there is no true momentum. The institutions simply use that liquidity to sell their massive positions. The price immediately reverses and crashes back down into the pattern, hitting the stop losses of everyone who just bought. The breakout was a fake out. How do we defend against this? We use the retest strategy. Imagine a prisoner escaping a fortress, the pattern. He smashes through the wall, the breakout. But before he runs into the forest, the trend, he often pauses and looks back at the hole he made to ensure nobody is following him. Price does the same. After a breakout, price will often return to the scene of the crime. It will come back down to touch the broken resistance line. This is the moment of truth. If the old resistance acts as new support and the price bounces off it, the breakout is confirmed. This retest confirms that the sellers who were defending that line have truly given up and flipped to become buyers. The aggressive trader buys the breakout. The conservative professional trader buys the retest. The aggressive trader gets caught in fakeouts 40% of the time. The conservative trader misses some moves but preserves their capital for the high probability setups. Let's look at a theoretical case study on gold, XAU/USD. The price of gold has been dropping for weeks. It hits $1,900 and bounces. It rallies to $1,950, then drops back to $1,900 and bounces again. It rallies to $1,940, then drops to $1,900 a third time. This creates a flat floor at $1,900. This is a descending triangle, usually a bearish continuation pattern. The sellers are getting more aggressive, lowering their ask price from $1,950 to $1,940, but the buyers are holding the line at $1,900. The pressure builds. Finally, a massive red candle smashes through $1,900. The floor has collapsed. Do you sell instantly? No. You wait. 2 hours later, the price creeps back up to $1,900. But instead of going back above it, it hits $1,900 and leaves a long upper wick. The floor has become a ceiling. This is your signal. You enter short. You measure the widest part of the triangle, say $50, and project it down. Your target is $1,850. You have turned geometry into profit. We have now assembled a terrifyingly effective arsenal. You can read the psychology of a single candle. You can map the structure of the trend. You can identify the invisible zones of support and supply. You can measure the momentum with oscillators, predict the retracements with Fibonacci, and recognize the geometric battle formations of chart patterns. You have every tool necessary to analyze the market. Theoretically, you should be ready to make millions. But here is the brutal truth. You can be the best analyst in the world and still go broke. You can predict the direction of the market with 90% accuracy and still lose your entire account in a single month. Why? Because analysis is only 20% of trading. The other 80% is not about what the market does. It is about what you do when the market goes against you. It is about how you manage the single most dangerous element in trading: risk. Without a mathematical fortress protecting your capital, one bad trade, just one, can erase months of hard work. Most traders treat risk management as an afterthought. We are going to treat it as a religion. In the next part of this masterclass, we are going to calculate the numbers that actually matter. We will discuss position sizing, risk-to-reward ratios, and the psychology of the drawdown. We will show you how to build a trading plan that can survive a losing streak of 10 trades in a row and still come out profitable. The fun part is over. The survival training begins now. Part 9 is next. Welcome to the ICU of trading. This is where we save the patient. This is where we stop the bleeding. Up until this point, everything we have discussed, candlesticks, support and resistance, Fibonacci, chart patterns, has been about offense. It has been about how to score points. But in the brutal arena of Forex trading, offense does not win championships. Defense does. You can be the greatest technical analyst in history, capable of predicting the turning point of the euro to US dollar to the exact pip. And yet, you can still end the month with a blown account if you do not master the mathematics of survival. Most beginners treat trading like a slot machine. They put money in, pull the handle, and hope for a jackpot. Professionals treat trading like a casino. The casino does not care if it loses a single hand of blackjack. The casino does not panic when a player hits a lucky streak. Why? Because the casino knows that over a series of 1,000 hands, the statistical edge is rigged in their favor. Risk management is how you rig the game in your favor. It is how you become the house rather than the gambler. Let's begin with the golden rule of professional capital preservation. The 1% rule. Shutterstock. This rule states that you should never, under any circumstances, risk more than 1%, or absolute maximum 2%, of your total account balance on a single trade. This sounds boring. Retail traders with a $1,000 account want to risk $200 to make $500 quickly. They want to flip the account. But let's look at the math of ruin. Imagine two traders, Trader A and Trader B. Both start with $10,000. Trader A is aggressive. He risks 10% per trade, $1,000. Trader B is conservative. She risks 1% per trade, $100. Both traders hit a cold streak and lose 5 trades in a row. It happens to everyone. Trader B is down $500. Her account balance is $9,500. She is emotionally stable. A few good trades will bring her back to break-even. Trader A, however, is down roughly $4,100, compounding downwards. His account is at $5,900. He has lost nearly half his capital. Here is the terrifying part. The math of recovery is not linear. If you lose 10% of your account, you need an 11% gain to get back to even. Manageable. But if you lose 50% of your account like Trader A, you do not need a 50% gain to break even. You need a 100% gain. You have to double your money just to get back to where you started. This forces trader A to take even bigger risks, leading to revenge trading, which inevitably leads to the death of the account. Trader B, by risking only 1%, ensures that she can survive a losing streak of 20 trades and still have 80% of her capital intact. She stays in the game. This leads us to the mechanic that confuses most new traders: position sizing. Many beginners ask, how many lots should I trade? The answer is never a fixed number. It is a calculation. You do not trade one standard lot because you feel confident. You adjust your lot size based on your stop-loss distance to ensure you are only risking that 1%. Let's walk through a step-by-step calculation. Scenario: you have a $10,000 account. You adhere to the 1% rule, so your maximum risk is $100. You spot a bull flag on the pound sterling to US dollar. You want to enter at 1.2500. Based on the market structure, Part 3, and the support zone, Part 4, you determine your stop-loss must be placed at 1.2480, below the recent low. That is a 20-pip stop-loss. Now the math. You have $100 to spend on risk. You have 20 pips of distance to survive. $100 divided by 20 pips equals $5 per pip. You need to trade a lot size where each pip movement equals $5. In Forex, one standard lot, $100,000, pays roughly $10 per pip. Therefore, you trade 0.5 lots, 5 mini lots. Now, imagine a different trade on the pound sterling to Japanese yen. The pair is more volatile. To be safe, your stop-loss needs to be 50 pips away. Risk remains $100. Distance is 50 pips. $100 divided by 50 equals $2 per pip. You trade 0.2 lots. Notice what happened. The volatility changed. The stop-loss distance changed. But your risk remained exactly the same. $100. Whether the market moves 20 pips or 50 pips against you, you lose the exact same amount. This neutralizes the fear. You know exactly what you will lose before you even click the button. Now that we have capped the downside, let's discuss the engine of wealth creation: risk-to-reward ratio, RR. This is the single most important metric in your trading business. It is the ratio of your potential loss to your potential gain. If you risk $100 to make $100, that is a 1-to-1 ratio. If you risk $100 to make $300, that is a 1-to-3 ratio. Why does this matter? Because it completely decouples your profitability from your accuracy. Most people think they need to win 80% or 90% of their trades to be rich. This is a myth. If you consistently trade with a 1-to-3 risk-to-reward ratio, you can lose the majority of your trades and still make a fortune. Let's simulate a set of 10 trades with a 1:3 RR. You lose 7 trades. You win only 3. You are a terrible trader with a 30% win rate. Losses: 7 trades x $100 risk equals minus $700. Wins: 3 trades x $300 profit equals plus $900. Net result: plus $200 profit. You lost 70% of the time and still made money. Now imagine if you improved your skills, using the technical analysis from parts 1 to 8, and reached a 50% win rate. Losses: 5x $100 equals minus $500. Wins: 5x $300 equals plus $500. Net result: plus $1,000 profit. A 10% gain on your account in 10 trades. This is the holy grail. It is not a magic indicator. It is the combination of tight risk management, stop losses based on structure, and high upside targets, Fibonacci extensions, and measured moves. If a trade setup presents a potential reward of only 1:1, you skip it. You are a sniper, not a machine gunner. You wait for the setup where the support is strong, tight stop, and the room to the next resistance is wide, high reward. However, knowing the math is easy. Doing it is hard. This brings us to the final hurdle: psychology. The market is designed to exploit your biology. When you are winning, your brain releases dopamine, making you feel invincible. You start increasing your lot size. You ignore your rules. You take a trade just to feel the rush. Then you lose. When you lose, your brain triggers the fight or flight response. You feel physical pain. You want to make the pain go away. How? By winning the money back immediately. You enter a revenge trade. You double your risk to make back the previous loss plus a little extra. This is the death spiral. The market does not owe you your money back. The market does not know you exist. To survive, you must detach your self-worth from the outcome of any single trade. You must think in probabilities. If you flip a coin, you don't get angry if it lands on tails. You know that over 100 flips, it will likely be 50/50ths. Trading is the same. A loss is not a failure. It is a business expense. It is the cost of doing business, like paying rent for a shop. So, how do we execute this? We need a rigid framework. We need a set of laws that we never break. We need a trading plan. A trading plan is not a vague idea. It is a physical document. It dictates exactly what time you wake up, dictates exactly which pairs you look at. It dictates your maximum daily loss limit, e.g., if I lose 2 trades in a row, I turn off the computer for 24 hours. It dictates your entry criteria and your exit criteria. You have the technical tools. You have the risk parameters. You understand the psychology. But there is one final step to turn this from a hobby into a career. You need to synthesize everything into a repeatable daily routine. You need to know exactly what to do from the moment you sit at your desk to the moment you close your charts. In the final part of this deep dive masterclass, we are going to build that routine together. We will walk through a day in the life of a professional trader. We will combine market structure, indicators, and risk management into a live checklist that you can print out and stick to your wall. We will show you how to journal your trades to scientifically improve your performance week over week. This is the graduation. Part 10 is the finale. You have arrived at the final gate. You have stripped the engine of the market down to its bolts. You understand the fuel of liquidity, the roadmap of structure, and the speedometer of momentum. You know how to calculate the risk of the journey. But knowing how a car works does not make you a race car driver. Driving requires a rhythm, a routine, and a psychological resilience that cannot be found in a textbook. It requires a transition from analyst to operator. Shutterstock. Most retail traders fail not because they lack knowledge, but because they lack process. They wake up, open their phone while still in bed, see a big green candle on gold, and hit buy out of fear of missing out. That is not trading, that is dopamine addiction. Professional trading is boring. It is repetitive. It is a checklist. If you want excitement, go to Las Vegas. If you want longevity, you come here. Let's construct your professional day in the life protocol. Imagine it is 7 a.m. Eastern Standard Time. The New York session is about to overlap with the London session, the most volatile and liquid time of the day. You sit at your desk. You do not open a chart yet. First, you check the economic calendar. You are looking for red folder events, non-farm payrolls, CPI data, or central bank speeches. Why? Because if the Federal Reserve Chairman is speaking in 30 minutes, technical analysis often goes out the window. Algorithms react to keywords in milliseconds. If a high-impact event is scheduled, the professional protocol is often to sit on your hands and wait for the dust to settle. We do not gamble on coin flips. We trade the reaction to the coin flip. Once the fundamental landscape is clear, you open your charts. But you do not zoom into the 5-minute time frame. That is for amateurs looking for a rush. You start with the top-down analysis. You open the weekly chart. You ask one question. Where are we going? Is the overall flow of the river bullish or bearish? You mark your major key levels. Then you drop to the daily chart. You look for the story. Is the market trending? Or is it stuck in a range? You check your 200 EMA. Are we above or below it? You are building a bias. Only now, with a macro bias established, do you drop to the 4-hour or 1-hour chart. This is your execution time frame. You are now a hunter waiting in a blind. You are not chasing the deer. You are waiting for the deer to cross your path. You scan your watch list of 5 to 10 pairs. You are filtering. You are looking for the A+ setups. If a chart looks messy, if the wicks are long and overlapping, if there is no clear structure, you close it immediately. Preserving your mental capital is just as important as preserving your financial capital. Let's say you find a potential setup on the Australian dollar to US dollar. The daily trend is up. The price has pulled back to a key support zone that aligns with the 61.8% Fibonacci level. The RSI is oversold but showing hidden bullish divergence. This is it. The alarm bells are ringing. But you do not click buy yet. You pull out your execution checklist. This checklist must be physical. Print it out. Tape it to your monitor. It is the firewall between your logic and your emotions. It should look like this. Structure. Is the trend in my favor? Yes. Area of value. Are we at a key support/resistance or supply/demand zone? Yes. Entry trigger. Do I have a confirmed candlestick pattern, e.g. bullish engulfing? or a chart pattern breakout? Waiting. Risk to reward. Can I place my stop loss in a logical place and still get at least a 1:2 return before the next resistance level? Yes. If you have 3 yes answers and 1 no, you do not trade. There is no compromise. If the risk to reward is only 1 minute and 1.5 seconds, you walk away. The market will be there tomorrow. The discipline you built by rejecting a subpar trade is worth more than the money you might have made from it. Now assume the candle closes bullish. All criteria are met. You calculate your position size using the 1% rule we discussed in part 9. You enter the trade. You set your stop loss and your take profit immediately. Then you do the hardest thing in trading, you walk away. You do not stare at the screen. You do not pray. You do not move your stop loss to give it more room. When it goes red, you let the probabilities play out. You have placed your bet according to your edge. The outcome of this specific instance is irrelevant. But the work is not done when the trade closes. This is where the science comes in. You must keep a trading journal. Most people think a journal is just a list of wins and losses. That is useless. A professional journal tracks the quality of your decisions, not just the result. You must record the date and time, the pair, the setup, e.g., trend continuation plus fib retracement, the entry and exit price. Crucial. A screenshot of the chart before execution and after the trade completes. Most crucial. Your emotional state. Were you anxious? Were you confident? Did you hesitate? Why do we do this? To identify leaks in your game. You might review your journal after 100 trades and realize, I lose 70% of the trades I take during the Asian session. Or, I lose 80% of the trades where I enter on a breakout instead of a retest. Data does not lie. This allows you to optimize your strategy. You might realize you are a terrible counter-trend trader, but an amazing trend follower. So you simply stop taking counter-trend trades. You cut the fat. You refine your edge. We also need to distinguish between a good loss and a bad win. A bad win is when you break your rules, you risk 5%, you chase a pump, you trade without a stop loss, and you make money. This is the worst thing that can happen to a beginner. It reinforces bad behavior. It teaches you that being reckless pays off. Eventually, the market will take that money back with interest. A good loss is when you followed your plan perfectly. You waited for the setup, you sized correctly, you executed the checklist, and the market simply went the other way. This is a victory of discipline. If you can pat yourself on the back for a good loss, you have made it. You are thinking like a professional. The journey you are embarking on is a marathon. Do not expect to quit your job next month. The learning curve in Forex is typically 18 to 36 months of consistent effort. The first year is about survival. It is about not blowing up. The second year is about break-even, stopping the bleeding. The third year is where the compounding begins. You will face drawdowns. You will have weeks where you do everything right and lose money every day. This is the filter. This is the barrier to entry that keeps the 90% out. When you are in a drawdown, you do not change your strategy. You lower your risk. You drop from 1% risk to 0.5% risk. You survive the storm. You wait for the market conditions to align with your system again. We have covered the history of money, the psychology of the candle, the geometry of the chart, and the mathematics of risk. You have the tools. But tools do not build a house, the carpenter does. You are the carpenter. The market is the wood. It can be crafted into a masterpiece, or it can give you splinters. The difference is your discipline. This masterclass was designed to give you the truth, not the hype. We didn't promise you a yacht, we promised you a probability model. We didn't give you a magic signal, we gave you a business plan. The rest is up to you. The charts are moving right now. The opportunities are forming. The flow of capital is endless. Are you going to be liquidity, or are you going to be the one providing it? Study these 10 parts. Rewatch them. Practice on a demo account until the execution becomes boring. When the excitement fades and the routine takes over, you will know you are ready. The market is open. Your shift begins now.